Hey everybody, I'm Jason Huerkamp with Living in Minneapolis, Minnesota and Keller Williams Preferred Realty. Today I'm here with Jeff Krast from Granite Bank, and we're going to be talking about the 7 things that you all can do to increase your credit score. So let's take it away. Jeff, you want to tell us a little bit about yourself and how long you've been in the industry?
Yeah, thanks, Jason. I've been with Granite Bank for about a year and a half. I've been in the industry for about 25 years. I went from the retail branches of working at a bank to owning my own mortgage company to being at Granite Bank right now. So I've kind of seen all aspects of the lending world. So, yeah.
Awesome. So first and foremost, we're going to talk about these 7 things, right? So number 1, pay your bills on time, right?
Yeah.
Can you elaborate a little bit more about that and how we should do that?
Yep, absolutely. Paying your bills basically affects 35% of your credit score. So as long as you're making your payments on time, it's going to keep boosting your credit scores. Anything with paying your bills on time is going to help you get a better interest rate when you're shopping, for homes, for cars, everything. It's going to keep increasing your credit score, and because the credit companies see that you're worthy of credit and being able to handle credit.
I've bought homes before and so forth, and typically when do those various companies, report to the credit bureaus? I know when I bought homes before, I believe they say after 30 days, that's when it gets reported on mortgages. Is that true?
Yeah, every mortgage is reported every 30 days. When it comes to credit cards and installment loans like cars and student loans, they can vary. Typically, they show up about the 5th of the month, but otherwise, some credit card companies do only report quarterly. So it kind of depends, but we can always, once we're doing a pre-approval or something, we can always get those updated and help your scores go up if, say, they haven't been reported for, 2 or 3 months.
Okay, so in theory with my home, if I wanted to really play life on the edge, I could wait till I was 20 days, past my original due date, and that's not going to adversely affect me with most mortgage companies, right?
Correct. And I think that's a misconception out there. We always want you to pay your bills on time, but if they don't get reported to the credit report unless they're 30 days late. So you always want to make sure you're making your payments within the 30 days of the due date, and it won't affect your credit. You will typically get a late fee of some sort from a credit card or an installment loan
or from your mortgage company. Will your mortgage give you a late fee or no?
Yep, they will usually after. There's a grace period of usually 10 to 15 days on all mortgages. So you do have that little bit of time frame to help supplement with when you get paid per month and things like that. But you always want to make sure your payments are paid within 30 days of the due date.
Yep, so as long as I'm less than 30 days late with most mortgage companies, that shouldn't affect me very much.
Correct, absolutely. Yep.
Okay, so ultimately, everybody, first and foremost, of the top 7, pay your bills on time. Pretty self-explanatory. However, it does get overlooked. So make sure you pay your bills on time, whether you like it or not. We have 3 really credit reporting bureaus. Can you explain a little bit about who those 3 are? Yep. I know one's TransUnion, right?
Yep.
And then there's Equifax, right?
And Experian.
And Experian. Yep. So those are the 3 places that effectively are going to report. And so as a lender, are you looking at all 3?
Yes, we take all 3 as a mortgage company. We pull what's called a tri-merge credit report, and it pulls all 3. And most typical mortgage companies are going to use the middle of the 3 scores. So if you have a 700, a 680, and a 650, they're going to do all our qualifications off the middle score of 680. So that's where you're gonna gauge your interest rates and things from.
All right, so number 2 is going to be reduce credit utilization. What does that mean to me? Because it sounds like it's kind of a little bit of a blanket statement. Yeah. So what are we talking about when we're trying to reduce credit utilization?
So credit utilization, the credit companies basically gauge your credit score based off of how much of your credit you're using. Typically want to try to stay under 30% of your available balance on your lines of credit and credit cards, things like that. That's going to keep you in the perfect kind of credit realm. You'll get a little bit of a hit to your credit score when you go over 50% of your credit card balance or of your limit, and it will start probably decreasing it if you use over 80% of the credit line. So you always want to try to pay it down under 30% at the end of each month if you possibly can, and that'll continually build your credit score up that way.
And is that ideally like, what happens like, with my mortgage? Because obviously, many people with their mortgages, they owe much more than 30% of, is it the
Right.
same effect there? Is that
Nope.
kind of locked in?
No, mortgages and installment loans are basically looked at more of payment history. As long as you're making your payment on time, you're going to keep increasing that credit score. It's only the credit agencies
Like the
are only
revolving-
utilizing your revolving credit.
Okay.
So they're basically gauging you if you're able to handle credit, because some people honestly can't. Some people can very well. If you have $1,000 line of credit, if you use $300 or less a month and pay it off or pay it down and keep it under that balance, they know you're not striving for credit and needing credit. Now all of a sudden they see you gauge it up to 50% or 80% or 100%. The credit agencies look at it like, okay, they need credit. Something's going on.
Yep.
They're utilizing it. So typically that'll drop your credit score because you're at a higher risk, of, overextending the credit.
Yeah, so ideally, if somebody had a $5,000 max credit limit for their credit card, they want to keep it under 1,500.
Perfect. Yep.
Right?
Right in that ballpark.
And if you had let's say you had a 50,000, credit card limit, basically you'd want to say keep it under 15,000, right?
Exactly.
So it basically is a linear scale on
Right.
how you want to keep that utilization. So the third thing that we're going to talk about is avoiding opening new credit accounts. And remember, guys, these are the 7 things that you want to do to increase your credit score and help you purchase a home. So let's talk a little bit about it. What do we mean by avoid opening new credit accounts? Tell me more about that.
Okay, so what it looks like is when you're shopping for a mortgage and you're getting pre-approved and things like that, you don't want to go in and open up a bunch of credit cards. What that looks like.
Do you want to open up any?
Not necessarily. Really, you need the mortgage company or a good mortgage consultant to kind of pull credit, look at your credit. Maybe you need a little bit of credit history, and they'll advise you, like say you don't have a credit score, they can advise to do like a secured credit card with your bank, or maybe get a Walmart or Target or some retail credit card to help boost your credit to get a score. But if you already have the scores established and credit history there, you don't want to pull your credit during the pre-approval process, because the more you pull your credit, the more it looks like you need credit. So
sure. So you're basically telling me, like, I'm going to buy a house. I want to make sure my score is as high as I can, because the higher the score, for the most part, is going to help me get the best rate possible.
correct.
So I don't want to really be there and say, oh, I'm going to go try to buy some stuff for the house, right? Like, I don't want to buy this stuff for the house before. But does that really apply to everybody? Because, like, we at Keller Williams, the Huerkamp Home Group, we work with people from, all financial backgrounds, right? We might work with very first home time, our very first home buyer, and we also might work with somebody that maybe owns a huge company. Is it applicable to everybody? Because I always see it as a blanket statement, like, don't get any credit inquiries, but is it for everybody, shouldn't, or just some people?
It's a general rule to go off of for credit. They're going to look at you pulling credit as a need for credit. So is it going to affect your credit score different from another person? Absolutely. Will it, if you pulling credit, say, and you already have, say, $100,000 in credit card availability, is it going to affect your credit score? Probably not near as much as somebody with a $500 credit card that might be almost maxed. That could it really comes down to your overall credit limit, not just one credit card, but credit limit on your credit profile. So I would say everybody's different on credit based on your past and future, buying.
So as a general rule of thumb, you really want to check with a mortgage professional to make sure that you're not opening up additional lines of credit unless your credit and your financial wherewithal would allow you to do so.
Right.
Because, I can personally tell you, I had a client many years back that, they were right there at kind of their max debt to income, and they went out and they bought a bunch of furniture. They thought because that furniture wasn't being delivered until after the closing date, and they had the 0% down financing and all this stuff. So they thought because of all that it wasn't going to affect them, and quite frankly, it did. They actually had to return the furniture. We had to delay the closing, and wait for a recast of the credit score. Can you talk a little bit about like recasting and how that works? Because sometimes we can help people, bump that score up, especially if they're, right at, a fringe level from, one tier to the next tier where they get a little bit better pricing. So talk about a little bit about like how a recast works if somebody did something that they shouldn't have and we're trying to reverse it.
Like a rescore.
A rescore
of the credit.
Sorry, wrong.
With the rescore, that's why it's really important that you have a good mortgage consultant to talk to, because once they have your credit, the credit reports have tools that are called credit wizards, and it can tell you exactly your potential to go up or down with a credit score. So say your credit scores are 607, 610, 619, and that better parameter for credit scores is above 620, it'll show you that you have the potential to go up 40 points on TransUnion, 30 points on Equifax, 20 points on Experian, and we can run these wizards, and it might be as simple as paying a $200 credit card down that's maxed to, $30. And if they do exactly what we say, basically it's about a 97% accuracy that we can help them. They make the payment, they submit the payment proof, we send it over back to the credit report, and we get new scores generated without having to re-pull the credit scores within 3 to 5 business days. So it can really help with that.
So a lot of times, like if somebody had a credit card and let's say they had a lower limit on it, right? Maybe it was $2,000, and for whatever reason they just kept that thing at $1,700 a month, and they're just paying off the interest, which unfortunately some people do. But let's say they had the funds to kind of pay that down and pay it off. Can you give us an example of maybe not a specific name or anything, but of how that's worked in the past? Because I know like you've had clients of mine, they've had to pay off like a vehicle in order to qualify, but they had the money, they just never thought that they should do it because they wanted to keep the money as a nest egg. So can you give me like an example of when you've done that and how that's worked?
Yeah, so perfect example, just this week we've been working with a client that she makes well into the 200s for income, $200,000. So, but our credit score was, below 600. We did a wizard. She had the money saved up for a down payment, but typically we want to get above a 620 to get at least into one level of FHA financing.
Sure.
We ran the wizard. She had to pay 4 credit cards down with a total of, I think it was like $2,300. We did that. We got letters from the credit card agencies stating that the new balance had been updated. So we took those letters, submitted them back to the credit agencies, and within, I think it took about a total of maybe 3 weeks for all of it, for them to get, pay the money down, things like that.
Yeah.
But we got them to a score of 570 and got their average score to 630. We ran the findings, or the automated approval with FHA. It came back approved, and now they're shopping for a $500,000 house.
Oh, wow.
And that's currently. So that's a great success story that can work with these credit rescores.
Awesome. Number 4 is pay down existing debt. We've already kind of touched on this a little bit, but Jeff, you've been in this for obviously a really long period of time. Tell me a little bit about why it's important to pay down the existing debt and how that affects your qualification.
Really, once we do the pre-approval process, we'll go in and kind of analyze the credit report, the income. You want to kind of overall keep below 43% debt to income if you can in the perfect world.
So how high can I go on a debt to income ratio, typically speaking?
Yeah, with a conventional loan, you can get approved up to like a 50% debt to income, and with FHA, the federal loan, you can go up to like 57% with your total debts.
Wow.
And your housing ratio, meaning your housing payment compared to your monthly debt, needs to be below like 47%, is how typically it works with the automated findings.
I can go as high as 57% rather, debt to income. So explain that to me. Is that like my net income? Is it my gross income?
Gross, yep.
It's my gross
so it's
income.
Your gross. So if you make potentially $4,000 a month, to get a conventional loan, you would have your house payment and all other payments that would be reported on the credit report under $2,000. So that way you'd be 50%, of your $4,000 gross monthly income.
Sure.
And that's kind of what we're shooting for when we're working.
Yeah, or if I made to get exact math, if I made $100,000 a year, right? In theory, I only could really be at $57,000 a year at the max
correct.
of what I'm spending on. What was that again? Like, what can that 57% compromise of?
Of your monthly payments of your gross monthly income is
Okay.
what it is. So so you take your car loans, your student loans, things like that. Anything that's on your credit report and or that you may acknowledge to us on the application, say you have a private loan that's not on a credit report for like $300 a month or something.
Yep.
Anything that's disclosed to us or that's on the credit report, we don't count your electric, your utilities per month. That doesn't go into the fact. It's just what's on your credit report.
It's just what's on your credit report.
Yep.
Okay.
Yep.
All right. So yeah, I can see if you really want to push the maximum limits, you can go up to 57%. Again, you need to talk with a qualified loan officer to make sure like you're getting the correct information for your specific situation, because your situation is unique to yourself. And correct me if I'm wrong, but really no two borrowers are going to have the same situation, right? It's always going to be
different. I think that's a misconception in the industry that you look at everybody and everybody's finances are the same. It really is different, because once we analyze your credit report and your finances, you might have a car loan that's $1,000 a month, and you want a $500,000 house.
And maybe I only owe 8 months on that car, right?
Yep.
Is that possible?
Yeah,
right?
And if it's under 10 months, typically we don't have to count that payment because we know that debt's going to go away eventually.
Okay.
But say you have,
But maybe it was a year, right? Let's say I had 20% down on my house. I had an additional $12,000 laying around. It would be beneficial for me potentially, depending on my situation, to pay that car loan off.
And we can pay it off at closing, or we could look at refinancing the car loan to get a lower monthly payment.
Okay.
All things that will, a good mortgage person will analyze and kind of look at. We either pay this debt off, we pay this down. It's not always a good thing to just see debt, go pay it off. It's better for your mortgage consultant to kind of see. And sometimes on like a credit card to get your scores higher, you pay the balance down to like $11. It's kind of crazy how the wizard works. But yeah, you just definitely want to have a good mortgage person kind of advise you on what to do with the paying off the debts.
So speaking of like a good mortgage professional, like what in your mind makes a good mortgage professional? Like what should I, if I'm a consumer, I only do this maybe 7-8 times in my life, like because a lot of people might not understand, everybody kind of throws around the that kind of terminology with really anything in life, but what does it mean to actually be a good mortgage professional?
I would say just experience and overall caring and figuring out a person's goal for their buying a house. Some people want a bigger yard, or some people want room for their children. You need more bedrooms, things like that. So when you determine what they want, that mortgage consultant should take that into effect and go, okay, so we need to get you into a house about $400,000 or $500,000 because that's the size of the house you want. You need to know that your mortgage consultant has been kind of through everything. So I've been through it 25 years. I feel like I've seen just about every situation that could come up, but new ones do come up. You just want to have somebody that has a backup plan. We're kind of like your pilot, with a turbulent flight sometimes. You want to always make sure the person that's leading you through this loan knows what he's doing, has the education, has backup plans,
or
even, things
right?
like
Yep.
that.
He or she.
You don't want somebody that is rushing you into something. They should be asking you the right questions. What's your goal? Just because you're approved for a $500,000 house, do you emotionally feel like you're comfortable with the payment? So like when I talk to somebody, I'll tell you what you can get approved for, and then we'll talk about what your comfort level is, and then you guys can kind of decide between, those payments and price points of what's more comfortable for you and your family, things like that.
Okay, that sounds awesome. Yeah. So number 5 is going to be check and dispute any credit reporting errors. So what can you tell me, what are errors? Do you find errors on the credit report?
Absolutely. We find a lot of things might be, say you had a past divorce that was not in your name. Maybe there's a credit card that's still out there that needs to be deleted off their account. There could be a judgment against somebody with a similar name or a collection on your credit report that might not be yours. So the rules are you can go to what's called freecreditreport.com once a year and get your free credit.
Nice.
So it'll show you everything that's on there, and you can pay a small fee and get your credit scores as well from Equifax, TransUnion, and Experian. And I completely advise you to do that so you know that what's on there is actually yours. Maybe there's a credit card out there that you didn't know. Maybe you thought you closed it and had a $1 balance, and all of a sudden they put lates on it because you never paid this $1 balance. I've seen things like that.
Wow.
So you want to make sure that's not affecting your credit score. Also, what you're looking for is, anybody with a similar name may have had something filed against them.
So if if you had a name of like John Smith,
Yep.
for instance, I mean, fairly common name, versus, my son is Crosby Huerkamp, right?
Yep.
He might be the only one in the
for
country,
sure.
right?
Yep.
He probably actually is the
Yeah.
only one in the country
Yep.
that's named that, right?
Correct.
So the more common the name is, the more likelihood that you're going to have the potentiality of having some sort of an issue with something that's reported that wasn't yours.
Yep.
So can you tell me, what's the most egregious thing that you've ever seen? I mean, you've been doing this a long time, so what's the most egregious dispute? Leave it kind of vanilla so we're not, really calling out a particular person, but what's the most egregious thing that you found?
I've seen a $500,000 judgment on a credit report
That was
wasn't
not
somebody's, that was not theirs.
And so how hard was that to get removed?
It wasn't. It was just a name affidavit. We had to find proof that it wasn't to him. We had requested the creditors send us the information based on their proof that this was the actual individual. They could not prove it. They could not prove that this person had ever been living at this address. I think it was a judgment on a foreclosure or something like that. But it actually was not the client's. Their credit score was like 530 because of it. So we actually got it removed. So everybody knows that if something's misinformed on your credit report, if you dispute it in writing to all 3 credit reports, they officially have 30 days to prove that it was yours. And if they can't, they automatically have to delete it from your account. So
but ultimately, that could have been costing those people thousands and thousands of dollars over a long period of time, and they didn't even know that they had that out there hanging over them, because obviously nobody took and told them, right? So I mean, it was, how much did it lower their score by?
Their score went up to almost 800 after we removed it.
Oh my gosh.
So they had been denied for things in the past, never really asked questions, and they just said, well, we can't get approved, so we're just not going to deal with credit. So they went years without dealing with credit, and that was what happened. We just said, well, something doesn't seem right. If you don't have anything that you know is out there, let's pull your credit and kind of see what it is. Mm-hmm. So they didn't use like Credit Karma, things like that. So we pulled it, asked them about it, and they're like, it's not ours. And we got it fixed. They got a credit card. They had a small credit card they were using from, I don't know where, Walmart or something like that. Yep. And that whole history took into play once that other thing got removed, and their score shot up, and they were homeowners within probably 6 months.
Wow.
Because of it. So
just unbelievable. But again, that gets back to, you want to make sure that you're working with the right mortgage professional to find things like that, because if you're just doing something at a glance, or someone's just like glancing at your credit report, I'm sure that if they don't have a good working professional relationship with you, there's a chance, obviously a lot of people miss that on their behalf. It probably costs them thousands and thousands of dollars that it really shouldn't have, right? Yep.
And I would assume, there's people are human. They're out there. They see a 570 credit score, and they're like, oh, I can't help you right now. Come back to me in 6 months. Unfortunately, I see that a lot, in the industry where, people don't take the initiative to help their clients and customers get out of that bind, where if they would have just listened and asked a few questions, it could have saved these people, who knows how much money.
With that being said, how easy is it for me as a consumer to view my credit report personally? Like, how easy can I see do I have to use you, or can I find it on my own, or how does that work?
Just that freecreditreport.com. I can go once a year and get it for free. So then I think it's like a $10 fee or something. You can actually get your score. So highly recommend to do that every year. I mean, I do it. Anybody in my family I advise to do it. What you don't want, what I see out there is everybody monitoring via Credit Karma, or hey, I get my credit score from my credit card, they tell me.
Oh.
Take those with a big grain of salt, because I've had people tell me that their Credit Karma score was 700 and I pulled it and it would be 610.
Really?
But also vice versa, where they thought it was 610, I pulled it was 720. Credit Karma and some of these monitoring systems that they say are accurate are not actually very accurate at times. They're more credit monitoring things. They see
you need to get it from the source.
Yeah, you
right?
need to go right to the source of, and if you come apply for a mortgage, you're typically getting your hard credit card pull, or your hard credit pull, where you're going to get your scores. You're gonna see what's on your credit report, instead of with Credit Karma, it's a fluctuation. You go and pull your credit 3 or 4 times in a month, Credit Karma is going to drop your credit score tremendously, but it might not be that accurate.
So you said the word hard credit card pull. I've also heard that there's something called like a soft credit pull. Can you tell me the difference between like a soft pull and a hard pull?
Yeah. So a hard pull is when we actually go in, pull a tri-merged credit report. We get your scores, we get everything. We can actually run your pre-approval to the T, get it all pre-approved and ready to go. A soft credit pull isn't as intrusive on your credit report. It doesn't affect your credit score at all. It's just basically a free look with a couple of scores. It shows you, what your scores are. It will not alert other lenders out there and other creditors that you're having your credit pull, and it will not, affect your credit score by doing that. So that's where a lot of people are going, and we have the ability to do that. It just, with that, we can't officially run what's called an automated approval with Fannie Mae and Freddie Mac and the big lenders that make the automated approvals. So,
yeah. So like who are Fannie Mae and Freddie Mac? Who are they?
So everyone hears about Fannie Mae, Freddie Mac, FHA. These are the big institutions that lend the money to banks, things like that. They are the ones supplying the money. We're locking the rates with them. They set the rules and when we buy and sell mortgages, things like that, they have a certain criteria you have to meet. The 50% debt to income, the 57% debt to income with FHA, all these things. They have the criteria that I would say 95% of lenders have to follow. Small banks are a little different. They can use depository money.
Could a big bank be different though too?
They can be. They have options. They're called non-QM loans. So you can go outside the box. Like
what does non-QM stand for? Is it like non-conforming mortgage?
Yes, pretty much. Okay, it's a non-conforming.
Okay.
It doesn't meet the criteria of what a normal mortgage is. So all banks, or a lot of banks have that ability, and especially smaller banks that use their clients' depository money, they can make decisions based off of, say, 20% down, and maybe they're a little outside the box, but they've never had a payment late. They've got money in the bank. They can lend this money based off a little bit higher interest rate is typically how it works, maybe a little bit more fees, but it helps individuals that really should be able to get a mortgage.
Okay, so let's say, speaking of individuals that should be able to get a mortgage, let's say someone is a business owner, right?
Yep.
And with the business owner, they file their taxes, they do everything right. On paper, there's a lot of business owners where it doesn't look like they make very much money, but they might have a ton of assets. They might have a ton of cash flow with their business. Can you talk to me a little bit about a scenario like that where I might not be the perfect person for a conforming loan with Fannie Mae and Freddie Mac? I want to buy a house. So what are my options as that?
Yeah, I get this question a lot. And typically these people have a lot of money saved up too for a down payment, because they know they've been denied or not been able to get the loan they've wanted in the past. So there's a couple different options. You can go through a smaller bank like that we have. We can kind of look at the income a little bit more outside of the box, a little less restrictive. We know people write things off. We can go that route and see if we can do what's called a portfolio loan.
Oh, sure.
A portfolio loan is when you're using the depository money of a bank to fund a mortgage, and we're holding the mortgage and servicing it ourselves. Another option is the non-QM loans. that are non-conforming, you can use bank statements instead. Say you have tons of cash flow. We know you're writing stuff off. You have tons of write-offs for your company, but you're still doing fine with the company. But say you have $20,000 a month coming into your bank statements. We can go over 12 months average of a bank statement or 24 months and use that income average to use an income and develop a loan that way instead of actually showing tax returns and things like that.
So do I need a credit score to actually buy a house?
Nope.
You don't?
You do not need
Really?
a credit score to get that. So they have updated that in the past few years where you can run these automated findings, and if it takes all the parameters, if you have more money down, you don't have debt, maybe you have a lot of assets left over, you can run it through the system, and the system does have the ability to approve you that way. And they're called manual underwrites in a lot of cases that way. You might get a little bit higher interest rate because you don't have that credit history, but there definitely is the ability to do loans without credit scores.
So Dave Ramsey ultimately will say you don't need a credit score to buy a house, and I guess at this point that's absolutely true. You don't technically need a credit score to buy a house. So they might be looking at like payment history though, and you can prove that through like utility bills and things like that, right? So you might pay cash for everything, but there's certain things that you really just can't pay cash for, right? And specifically like your utility bills. So you think about your electric, your gas, your water, your telephone,
your rent
if you have rent. So you could look at all that payment history, and you're kind of building a credit score in the background. Not really, but the financial lending institution that's vetting you is saying, okay, wait, now I can see that this person has never missed a payment on all their utilities, and they're whatever those are, and they're like, and then they got a bunch of money in the bank, like they might be very, very worthy. So I appreciate that.
Yeah,
so
all kinds of options.
There's options that you have out there. Number 6, become an authorized user on a responsible account. So what can you tell me about that, Jeff?
Okay. So in the past one, in number 5, we had talked about maybe no credit scores that we could get approved. So say it doesn't work. Say the system, or we just can't get it to work without a credit score. You can actually say you have a mom, a dad, or a significant other that you're married to, or something like that. You can actually be added as an authorized user on their credit account. So how that works is you want obviously a responsible person that has paid their bills on time. The longer the better, actually. So once you get added as an authorized user, you'll get a card for that account. You'll want to use that card. Just being added to it doesn't necessarily.
It's mainly credit cards that we're talking about?
Typically, mostly credit lines.
Okay.
So you can do that, but what happens is after you use that credit card for a month or two, that entire history from that credit card can be transferred to your credit report. So that really helps. All of a sudden it goes from no credit history to potentially all the way back until you're 18, I think it'll go back to, or something. And you'll all of a sudden have this added credit history, and it'll almost instantly generate credit scores. Usually it takes about 3 to 6 months to do that now. It used to be where it was almost like within 30 days, but they kind of want to make sure you're making payments and stuff, but maybe that's the route we go. But yeah, absolutely you can do that, but 100% you want to make sure it's a reliable credit, past.
So how many, you've had a few people do this in the past? I have actually never heard of it, and I've been in the industry for now 24 years. I've just never heard of anybody doing that.
Yep. So I've probably done this 100 times in my 25-year career.
Wow.
And it normally works just fine. It's just the timing sometimes differs of when it comes. Now, when we're fixing credit, sometimes it works the opposite way. Somebody might have an authorized user. Oh, that's my mom's card. I've been on there since college. Well, maybe mom has the credit card maxed out, and it's making your credit score go down. So we'll go in, have them remove themselves an authorized user, get that updated, and all of a sudden that could jump your credit score. So you can utilize that, authorization of another account in both directions.
Awesome.
So.
Number 7, let's keep old accounts open. Like, why would I want to keep old accounts open? Like, maybe I had like a Macy's card, right? I haven't used it forever, right? Yeah. But I got it when I turned 18 in 1995. Now I'm really dating myself, but I got it in 1995, right? And I have that account. It's still open. It's the Macy's account. Like, do I, why do I want to keep that?
Okay, so I get this question a lot actually. Say we're working on somebody's credit, or they're trying to get approved for a mortgage or something, and they come into money, or I advise them to pay stuff down. They'll be like, okay, I'm going to go pay, I'm going to pay this off, pay this off, pay this off, and I'm going to close the accounts. Well, you do not want to do that, because that affects your overall credit availability, is basically what it affects. Because if you have all that old stuff out there, it's showing that you have it available and that you've chosen not to use it. So it's actually helping your credit score.
So this might be one of the few times in life that older is better.
Yeah.
Right?
Exactly.
So you're telling me, like, those old lines, they have a lot more weight than a brand new line on my credit score, right?
Yep. So a lot of people will be like, okay, so I'll tell them, let's pay off these 3 credit cards, and they'll jump to the conclusion right away. Okay, I'm going to pay them off and I'm going to close them, and I'll tell them, no, don't close them. We just want to pay it off, so it shows your availability is that much more. You're at like a 90% availability instead of a 50% availability on your credit cards by doing this. So then it works out great for your credit to go up. Now, if you close them, say you close them and leave just one credit card open for $1,000, and you have a $900 balance on it. You're all of a sudden utilizing 90% of your credit availability, and your credit score could tank up to 100 points just by doing that.
Yeah, and I mean, case in point, I did close that old Macy's card, actually. I totally closed it, and my credit took a dump. I hadn't used that card in forever. It only took me probably about 6 months to get it totally built back up, and I did that on myself. I didn't work with a qualified mortgage professional. I just did it by myself, and it wasn't like I did anything. I just paid my bills on time, but it really took about 6 months before I didn't see that hit anymore, because I had that line open at the time that I closed it for like 20 years, and unfortunately I took that big hit. So those are the 7 things, guys, that you want to be sure that you do to increase your credit score overall. With any questions you might have, you can shoot us a text with the link down below, or an email is fine. With Jeff or I, all of our information is down below. And we look forward to seeing you on the next blog, and we will see you at the next house.
Thanks so much.